Hi there, welcome to Kneppy Invest. I wasn't going to do a video on MoneyMe because what's been happening with this company over the past month or so has been quite crazy. We had seen a significant drop in the share price leading up to news. They're going to do a capital raising. And then over the last few days, the share price has shot up like a rocket. Today, last time I looked, the share price was up about 30% on pretty high volume. So potentially this capital raising the company did make the other day has eased the fear in regards to the market about this company. And then when they did announce a capital raising, they also gave a trading update. And based off the first 2 months of the year, the company announced they were profitable by $9 million in those 2 months, which is absolutely crazy. For a company to be raising a lot of money at a significant discount and then come out and say, they're actually profitable by $9 million. And no doubt the CEO would have used that very fact when he went out there to try and sell this placement to institutions. So in today's video, I'm going to talk about the craziness of MoneyMe. Not the sort of company I would invest in for the long term. I'm not the biggest fan of these type of companies. I'm not the biggest fan of banks. I'm not the biggest fan of financial services company. I will invest in them on occasion, but sometimes you get this craziness happening in these sectors. And one thing I will say is the financial services sector is quite fragile and unstable, particularly when times are tough. And a company like MoneyMe is experiencing that right now. The best way to describe MoneyMe is they are a digital non-bank lender. Now, the few things going for MoneyMe is they are a disruptor to the traditional banks. So that is definitely one thing going for this company. And this is a particular slide they do use comparing themselves to the traditional offerings. For instance, straight through processing, capable of delivering funding within minutes. Probably can't get that at a bank. 100% digital experience, fast automated decisioning. More likely can't get that at a bank. 24/7, any hour of the day, weekday or weekend. 75% of calls answered within 10 seconds. More than likely, you can't get that with a bank. And not only that, I did have a look at the rating online. They have really good ratings. I think there was one place where they had a 40.8 rating. So those people who do use MoneyMe services really like what they're doing. And that's another thing going right for this company. MoneyMe hasn't been around that long, in fact, about 10 years, founded in 2013 and listed on the ASX in December 2019. So maybe bad timing there, just before the COVID-19 financial panic. We'll have a look to see how the share price was affected during that period of time. You would expect it was significantly affected, and then we would have seen sort of like a V-shaped recovery. But a few interesting things I found in this particular business view that was found or is found in their financial report, their half-year financial report that they would have released towards the end of February. So they also provide credit cards, unsecured personal loans, secured motor vehicle financing, and a credit score service. So I'm learning a little bit more about MoneyMe by doing research for this video. And this company is growing at a fairly quick rate. And understandably, it should be growing at a fairly quick rate because they are a disruptor, or they want to be a disruptor to those traditional lending services like the banks. So $1.2 billion in gross customer receivables, and that has grown tenfold since they listed on the ASX in December 2019. And there's one thing I wanted to know about this company. How do they get their funding? It's because the traditional banks get their funding through deposits, that sort of thing. That's not the only way they get funding. So it's deposits and also loans elsewhere. But this business gets their funding through a combination of corporate term debt, warehouse securitization facilities, and positive operating cash flows. Now, I would, in an ideal situation, in a perfect world, I would prefer MoneyMe to get all their funding through positive operating cash flows, but that's not how it works. And that's an unrealistic aim for MoneyMe at this point in time, probably forever. It's an unrealistic aim. And the other really interesting thing about this company that is found in the half-year results is that they are profitable by $9 million in the first half of 2023. So this is a chart for MoneyMe, not the latest chart for the company, because this particular chart goes from when they list on the ASX the start of 2022, before we saw the general tech sell-off. And this company, of course, because they are a financial tech company, would have seen the share price significantly affected by the general tech sell-off and, of course, rising interest rates. So they listed on the ASX just before COVID-19. Share price actually went up to about $2 just before March. And then the share price fell from $2 all the way down to 50 cents. So the share price decreased 75% during that time. And it wasn't quite the V-shaped recovery you might have seen in some other companies. It took a while for the share price of MoneyMe to get back up to the levels we saw before the COVID-19 financial panic. In fact, it took all the way up until June of 2021. It tried in late August, early September of 2020. You can see share price actually got back up to $2, and then it fell back fairly quickly. So $2 was a pretty good resistance level based off those two price points back in February 2020 and August 2020. But share price pulled through $2 fairly quickly in June of 2021. And the share price went sideways before we had the general tech sell-off in 2022. Now, at its height, when the share price got up to about $2.50 in June 2021, the market cap of this company was $400 million. Now, because this company gets all their funding through corporate debt and stuff like that, and because they've got $1.2 billion in receivables, this company is going to have a lot of debt. And they do have a lot of debt, about $1 billion in debt. But that's okay, because this is how this company gets their funding, to loan out money. And hopefully, the interest rates on their debt is way less than the interest rate they charge to their customers. That's how companies like this make money, unless, of course, they have deposits. So this is their active warehouse and term facilities. And a couple of interesting things here is in the middle, there's a Society 1 Funding Trust number 1 and a Society 1 Funding Trust number 2. And I think it was the second one or the first one I mentioned, which caused a little bit of issues. And that's why they had to raise cash, because that facility expired in April 2023. Now, not the biggest expert about these warehouse facilities, because quite a few of them expire this year. There's one expires in July 2023, two that expire in September 2023. And I'm just wondering, this is just me wondering, how this will affect this company moving forward. Because if this one that expired in April 2023 affected this company and the need to raise capital, what happens when these other warehouse facilities or term facilities expire later in the year? Now, let's have a look at the recent balance sheet from the half-year results. And the main thing I probably would look for in any sort of financial services, particularly the banks, is just comparing the total assets to total liabilities. And you want the total equity to be positive. And it has increased from last year to this year from 91.3 million to 121.9 million, which is all positive. Net customer receivables, 1.2 billion, down a little bit from 30th of June 2022. And their borrowings has also decreased a little bit, which is a little bit of a concern, which shows maybe the business has been slowing down a little bit. But they did mention they are trying for more high quality loans, which may not be a bad thing. I don't know much about how to run these sort of businesses, but maybe that's what they should be doing, looking for more high quality loans, because with rising interest rates, there's a better chance that the lower quality loans, those customers won't be able to pay MoneyMe back. Now, one concern I did have about MoneyMe is just going back through the last two capital raisings, and they're fairly close together. So the first one was in the 1st September 2022, and then just 6 months later, they needed to do another raising on the 23rd of March, and just the discount was pretty high. So the first one in September last year, the discount was at 27.5%, and the most recent one was 24%. And then just look at the offer price. The first one in September last year was at 50 cents, and the most recent one, which we'll talk about, was 8 cents. The first raise was for $20 million. This one was $37 million. Market cap at raise in September, it was 164 million. The market cap at raise now was only 29.7 billion. So no doubt, if they're raising $37 million, this company is going to highly dilute their current shareholders. So let's have a look at the most recent chart. This is the updated chart from the end of September all the way through to the 5th of April. Now, I'm recording this video. Current time is 3:52 p.m., not AM. I'm not that crazy. And so the market is just about to close. Last time I looked, the share price of MoneyMe was at 14 cents. It's been as high as 15.5 cents today. And the share price has rallied over the last few days on really strong volume. But you can see the share price started to turn into a downtrend in February of last year and went into a really well-defined downtrend. Now, there was some signs of life back in January. I think it was the 31st of January this year, when the share price shot up 60% on the back of a positive trading update from the company. And then the market just sold off. Extraordinary sell-off in MoneyMe from that date all the way through to the 20th of March, when they went into a trading halt. Share price fell from 50 cents all the way down to 10 cents. We'll have a look at the last about 10 days of trading in this company. And I think the market was really concerned, and either they were really concerned about MoneyMe as an ongoing concern, or as an ongoing entity, ongoing business, or they were really expecting a capital raising done at a significant discount, just because of the significant sell-off we saw on the market in regards to MoneyMe. And I'll show you that significant sell-off in a second. So here is that 31st of January announcement that did cause a little bit of short-term excitement in MoneyMe. Share price rose 60% on this day on pretty strong volume. But I think this just gave those who wanted to sell out an opportunity to sell out, and they sold out, and they continue to selling over the next month or so. And this was a pretty positive trading update if you look at it in isolation. Statutory net profit after tax of $8 million, up on the previous corresponding period, which was a loss of $19 million. Record gross revenue of $117 million, up 143%. Record gross revenue in the second quarter of $60 million, up 140% on the previous corresponding period. And core operating expenses down 3% on the second quarter of 2023, down on previous corresponding period, 11% on the second quarter and 5% on the first quarter. So understandably, I can see why the market reacted quite positively to this, but the negative sentiment in this company returned virtually the day after this positive announcement. And then the company went into a trading halt, something like the 20th of March, remained in trading halt for a while because more than likely the CEO was trying to raise money through institutions, and he could have been finding it hard, even though he had a really good trading update to give institutions. And I think if he didn't have that trading update, if he couldn't show that the company was profitable in the first 2 months by a significant amount, something like $7 or $9 million, he would have had way more trouble raising these funds. So he eventually raised $37 million through a placement at 8 cents, which was a significant discount by 25% from the share price the day they went into a trading halt, to issue about 462.5 million new shares, which means the shares on issue for this company will more than double. And that's very important. So this capital raising is highly dilutive to shareholders. Now, that 8 cents was a discount, 24% discount to the share price, as I've mentioned before, and keep going through that. So this placement, or this capital raising, is going to be used to pay down that corporate debt facility. So full repayment of the short-term Society One acquisition component and improved commercial terms on the remaining $50 million corporate facility, including a 200 basis point reduction in analyzed interest costs, driving cost savings of circa $7 million per annum and the potential for further savings. Also, relaxed covenant settings, and then the remaining balance due November 2025. So overall, it does look positive on the surface, this capital raising. There are some benefits around it. There are also some things you don't like to see, particularly highly dilutive, and also 24% discount to the share price. But I think this had to be done. And I think the market was expecting this, or the market was expecting this company to not last much longer. Now, the company also gave a trading update, and I did have those numbers mixed around. I thought the statutory profit for January, February was $9 million, and the profit for the first half was $7 million. But even so, this was an impressive trading update. Profit in 2 months, the first 2 months of the calendar year, $7 million. Gross revenue of $42 million, and office operating costs to income ratio down from 23% to 17%. And I think no doubt the CEO would have used this sort of information for or in their capital raising to sell this placement to institutions. Now, let's talk about the crazy trading of MoneyMe before this company went into trading halt. I'm talking about the previous 7-8 days before this company went to trading halt. Now, on the 9th of March, the share price of MoneyMe was 18 cents. Remember, the share price of this company was something like 60 cents or 50 cents when they released that positive trading update on the 31st of January. So the share price decreased from that level all the way down to 18 cents. And then leading up to the company going into trading halt on the 20th or 21st of March, this is what happened to the share price in consecutive days. Down 3%, down 11%, down 3%, down 3%, down 17%, down 4%, down 9%. Share price decreased from 18 cents to 10.5 cents. So not quite a decrease of 50%, but getting close to it. And then the company went into trading halt. So you could be a cynic or cynical and say or argue that someone in the market, someone knew about MoneyMe needing to raise capital, and they were selling out to prepare themselves to buy back in at 8 cents in the placement. Now, you'd have to be cynical to think that, but you can't discount it. And then the company came out of the trading halt on the 30th of March. Share price actually dropped 19% on that day. At one point, the share price was as high as 13 cents, but it closed at 8.5 cents, just above the price of the capital raising. And the last 4 days, the share price has risen 5.8%, 1%, 20.9%. And as I'm talking, the share price of MoneyMe is up another 27.3% on the 5th of April. So this is telling me, and pretty good volume as well. So this is telling me that the market likes this capital raising and they're less concerned about the future of MoneyMe moving forward. That's all I have for this video, looking at the craziness trading of MoneyMe over the past few months, in particular leading up to the trading halt that they went into because of that capital raising, and the craziness trading has continued after they come out of this trading halt, and the share price has now started to go in the complete opposite direction, which is telling me a few things about this particular capital raising. Now, there are some negatives about this capital raising, some positives. If you're a shareholder of MoneyMe and were a shareholder of MoneyMe before this capital raising, I'd love to hear your opinion on this particular capital raising. Now, the share price has significantly increased from the placement and capital raising price. Will you partake in the share purchase plan? And more than likely you will want to, because of the significant premium now of the share price. And because the share price is at a significant premium to the share purchase plan price, that means more than likely they'll have to scale back. So if you request $10,000 worth of shares, more than likely you'll be only given $1,000 shares. I think that's more likely to happen because of what the share price has done over the last few days. But who knows? The share price could absolutely fall off a cliff and go back down to 8.5 cents. Anyway, I'd love to hear anything from you if you are a shareholder of this company and what you think of the capital raising, what you're going to do moving forward. Are you going to plan on holding shares in this company for the long term? And what's your thesis behind holding shares in this company for the long term? I'd love to hear your thoughts. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. Time is 4:06 p.m., which means the market has closed. And share price right now is 15 cents. Indicated price 16 cents, but that's on 15 shares traded. So anyway, that's it for me today. Have a good day. Talk to you later. Bye.